we're super excited to really help you finish 2025 strong and position you for a successful, prosperous 2026 and a fulfilling life well beyond that. So today's program just is, we're going to share our disclaimer with you. This is for information purposes only. Any of the, this is not meant to be actual advice or recommendations. It's for education purposes only. So we always encourage you to check with your advisor, your tax consultant, and so on before making any moves. So our speakers today, we're super excited to have them here, are three of our colleagues here at CAIA Advisory Group. Mike Rarey, who is a managing director and works closely with the investment team. Molly Powers is certified, and Mike Rarey is a chartered financial analyst and a former principal of Capstrat. Molly Powers is a certified private wealth advisor, and Carrie Shapiro is a certified private wealth advisor, CFPs, as well. And they are going to lead us in this program, and we're excited to have them. So, Mike, I'll turn it over to you to get us started.
We'll go through markets and our outlook, and we're going to take a few slides and just focus on what has happened, what's going on right now, and then spend the rest of the time really talking about how we think you all can potentially prepare your portfolio for 2026 and the types of things that we're talking to clients about. So we'll start here and just recap what 2025 has looked like. If you just look at the returns across different areas of financial markets year to date, it's just green across the board. And you would think, wow, what an easy ride up and to the right. But we know it was a lot different. It certainly wasn't an easy ride up and to the right. From February 19th through April 8th, most areas of financial markets were down 10% or more. And there were obviously some extreme shifts in public policy and some pretty fantastic news highlights that made it sort of a white knuckle ride there for a while. And then the recovery has been basically the mirror image. So this has been one of the sharpest recoveries from that type of a drawdown that we've ever seen. So there's been a tremendous amount of volatility, and just staying invested the whole year and being comfortable with your portfolio certainly was not an easy task. So talking about what's going on right now, some of the things that investors are fearful about. One is the labor market. So with the government being shut down, we haven't been receiving non-farm payrolls reports, and we know there's been a ton of news headlines about job cut announcements, layoffs, et cetera. We're trying to translate how the market is thinking about this risk. And at this point, the market is looking right through any slowdown or weakness in the labor market, because that means to the market that the Federal Reserve, is going to cut interest rates to try to stimulate economic activity. So we think the Fed is going to cut interest rates again in December, and then perhaps 2 more times next year. And that's really helping markets look through any slowdown from tariffs, any weakness in the labor market, et cetera. So that's been definitely a stimulative force that we think will continue into 2026. Something that's special about these interest rate cuts this time around is that we think they're going to be particularly stimulative to the economy and to markets. You know, that's not always the case. You may recall when the Federal Reserve was cutting interest rates in 2008, it didn't feel great at all. Markets didn't even respond positively. This time, we think it's going to be a little different than that. And a couple reasons for that. One is the U.S. economy is blessed with a tremendous amount of cash just sitting on the sidelines. Businesses, households, about 23% of the economy parked in money market fund assets, or money market fund assets on par with about 23% of the economy. So as the Federal Reserve lowers interest rates, the yield that folks are getting on those money market fund assets is going to go down. It's going to be less attractive. And they're going to say, hey, maybe I should do something else with this money. Maybe I should buy something with it, invest it in other riskier areas. But either way, there's a whole bunch of dry powder on the sidelines. and the Fed is incentivizing folks to do something with that money. So that's going to be stimulative. And then the other factor is US households in aggregate have pretty clean balance sheets. A lot of folks cleaned up their balance sheets during the COVID-19 pandemic, and they're still sitting on relatively low debt levels. So they have the capacity to take on more credit, make more purchases. They might not have the willingness because interest rates are so high. So as interest rates come down, perhaps they'll be more willing, and that can incentivize more spending based on credit as well. So we think these interest rate cuts that Fed started already in this year and is going to continue into next year, we think they're going to be pretty stimulative for markets and for the economy. Another reason why we see a reacceleration in economic growth and earnings in 2026 is we are expecting a record year for individual income tax refunds. The One Big Beautiful Bill Act, it was a lot of the tax cuts and credits were instituted retroactively. So they applied to the 2025 tax year, but withholdings were not adjusted. So basically, folks have overpaid taxes this year, and that will come to them in refunds next year. We estimate $412 billion in total income tax refunds in 2026. On a per household basis, that's $500 more per household next year than households received this year in refunds. So $500 extra per household. I mean, that's on par with sort of early COVID stimulus checks. And we know how stimulative those ultimately were to the economy and earnings. So we're pretty excited about that as well. So we feel pretty good about the trajectory of the economy and earnings. But taking a step back, what are the opportunities for investors? How are we thinking? How are we advising our clients? And how are we managing client portfolios? The risk you have right now in the market is that the US equity market is very expensive and it's very concentrated. So if you take the 10 largest stocks in the US equity market, think Nvidia, Microsoft, Apple, Google, et cetera, they represent 35% of the total US equity market. So that's the most concentrated the US equity market has ever been. So if you have a broad indexed passive portfolio and you think, wow, I'm diversified because I own 3,000 stocks, you probably have over 35% of your assets in only 10 stocks. So how diversified are you really? And what we've seen historically is when the market gets top heavy or concentrated like this, it's harder to diversify your portfolio, but the benefits to diversifying it are greater. So the way to look at that is over the next 3, 5, 10 years, starting from points like this when the market is concentrated, we see smaller companies outperform larger companies by about 3.5% annualized on average. I mean, that makes a big difference to a financial plan. So that's one thing to think about. How diversified are you really? And then the other great news or silver lining here is it's really only one area of the stock market that's very expensive. And that's, we have it represented by the NASDAQ 100, but it's really just the mega cap growth stocks. Those names I already mentioned, Nvidia, Microsoft, Apple, Google, et cetera. Those stocks that make up a huge portion of the index. The NASDAQ 100, which is most heavily exposed to those types of stocks, it's 90% above its long-term return trend. So if in a given year you expect a NASDAQ 100 type index to earn 10%, well, it's been doing way better than that for a really long time. And now it's 90% above that trend. That is the second most expensive it's ever been. So if you're worried about us being in a bubble, good news is we're clearly not, because in the early 2000s, the NASDAQ 100 was 250% above trend, so it's nothing near that. But this area of the market is expensive. And as I was talking about the silver lining, back in the early 2000s, it was basically pick the cleanest dirty shirt. there were no other areas of the stock market that were cheap. Everything was expensive. So there was a ton of risk. Now, thankfully, if you look at large value stocks, think like dividend paying, steady Eddie type stocks, Coca-Cola, Procter and Gamble, those types of companies, they're only 13% above trend, which means going forward, we expect about 8.5% annualized return for that area of the market. And they're much lower volatility, much less risky. And then if you go into things like smaller cap value stocks, foreign stocks, they're actually below trend. So they're cheap, meaning they have higher future expected returns. So it is harder to diversify now because the market is so concentrated, but we think the benefits to diversifying are greater because of how top heavy the market has become. So that's definitely something that we think is really important for everyone to think about and look at if they're meeting with your advisor, if you're going through your portfolio on your own. Just remember, owning the entire US equity market, you're maybe not as diversified as you thought, and you have to be much more intentional about how am I going to diversify my assets going forward.
Yeah, Mike, thank you for sharing more about the market outlook. Obviously, investments are such a critical part of all of our financial plans. And that's really where we'd like to transition the conversation to. So as we think more about creating your financial plan, we'd encourage that your life plan be aligned with your financial priorities. And when we think about financial plans, typically that's including things like when you want to retire, how much you spend today, how much you'd like to spend in retirement, cost of education for your children and how to save for that today. Even things like purchasing a second home and your legacy goals are integrated into the financial plan. And by having a plan, it ultimately takes away the uncertainty of, do I have enough? Will we have enough as a family, if you have a family, and creates that confidence in the path forward with accountability. So moving on, as you reflect on your financial plan, one of the core building blocks of any financial plan is savings. And with year-end approaching, here are some important savings limits to be aware of. So there's a lot of detail here. We're going to go through the various building blocks, but certainly happy to touch on more specific questions. But for 401k and 403b contributions, be aware these need to be made by 12/31. The employee contribution limit is $23,500. If you're over the age of 50, you have an additional catch-up contribution of $7,500. This year, there was a provision that was added that offered additional capacity to save if you fall between the ages of 60 and 63. And this is an added $3,750 on top of that catch-up. But if you haven't maxed out your retirement account savings today, then double check your pay stub or even look on your retirement website and ensure you're maximizing these contributions. There's still plenty of time between now and the end of the year to adjust your withholding to max out. We'll touch more on the IRA contributions as these are different than retirement contributions. And we'll touch more on that on the next page. But the 2025 limits are noted here for both IRAs and SEP IRAs. But one question we do get often is if you have a child that has W-2 income, they are eligible to save into a Roth. And if they have earned income or a maximum of $7,000 in 2025, they can save into that Roth IRA and build long-term growth in a tax-free account, which is a very powerful savings tool. So moving on to HSAs, if you're enrolled in a high-deductible health plan, you're eligible to contribute to the HSA. And the limits are noted here on the slide. But HSAs can actually be funded until the tax deadline. But be aware if you're deducting these contributions from your payroll, these do need to be made before the end of the year. And the advantage here is really that you're saving an additional 7.65%, which is the FICA tax, off your payroll when you're making contributions. So if you don't maximize the contribution through payroll, you still can make that contribution out of pocket, but just something to be aware of when it comes to the unique rules on HSAs. One other thing that we want to ensure you're aware of, if you have an adult child that you're covering under your high deductible health plan, and they fall between the ages of 19 and 26, they can actually save into their own HSA. This is called a super HSA, and they can contribute up to the family limit. So again, just different ways to save in a tax-free structure, we feel is a very attractive opportunity. So something to look into. Happy to address questions on that. Awesome. Let's touch next on gifting, whether it's directly to a family or friend or even saving into a 529 account. The limit for 2025 is $19,000 per person. So ensure deposits are made or checks are cashed to count for 2025. For 529s, if you're looking to take advantage of a state tax deduction, that may be offered depending on the state in which you live. Just ensure those contributions are made before year end. But if you're gifting, if you gave family or friends funds in excess of the $19,000, you and your spouse, if you're married, can each give $19,000. But just be aware that you may be required to file a gift tax return if you give in excess of that total amount. So there's no taxable consequence, but it does go towards your annual gift lifetime exclusion amount. So want to ensure you have proper documentation there. And then the final point here is regarding inherited IRAs. There's some unique rules when it comes to inherited IRAs depending on when you inherited that account. So if you inherited an IRA prior to 2020, this account needs to be withdrawn from in perpetuity. The required minimum distribution must be satisfied. Otherwise, you might be subject to penalties. If you inherited an IRA after 2020, previously the RMDs were waived. This year, you do want to ensure that you're satisfying that required minimum distribution. But you must also distribute that over a 10-year period from when your loved one passed. So evaluating year by year, if there's any tax opportunities to take a more significant distribution, it's really something we strongly encourage you look at between now and the end of the year, because certainly you don't want to get to year 10 and you have a massive spike in income from the distributions there. So those are some of the key numbers to know. Now we'd like to talk more about different savings options and offer a real life example of how we're helping clients optimize year-end saving strategies. So in our year-end meeting, we had a client who they shared they're receiving a bonus between now and the end of the year, and they turned 50 this year and hadn't elected the catch-up contribution in their 401k. Sometimes that is a different bucket that you need to elect on the website. But with this bonus coming, we help them to initiate the catch-up and also activate the after-tax 401k contribution. And that after-tax contribution can be converted into the Roth 401k. But this is the strategy that's known as a mega backdoor Roth. And in this case, the client could save an additional $25,000 based on the parameters of their plan. But again, it's the additional opportunity to save above and beyond those limits we previously highlighted. But with this client, we also help them to build out that cash reserve bucket for emergency savings. They hadn't quite hit the 6-month target we'd like to see. And then we also talk through setting aside some funds for a planned vacation next year and even funding their backdoor Roth IRA in 2026. So the backdoor Roth IRA is different from the mega backdoor Roth, which is part of the 401k plan. But typically we hear that people feel they earn too much money and cannot contribute to a Roth IRA. But if you don't have any IRA balances, you can actually contribute to a traditional IRA, and this is a non-deductible contribution, and convert it into the Roth IRA. It's subject to the $7,000 or $8,000 limit if you're over age 50. But again, it's additional opportunity for tax-free savings. Happy to highlight more on that process if there's questions at the end of the session. But as you can see, the holistic approach of reviewing cash flow and major expenses, even looking at account balances and account savings, and then tying that to the tax profile really can ensure that your plan is on track today and for the future. So that's just a good kind of gut check as you look at some of these items noted here on the slide as well. But so moving on, as with any journey, it's important to know where you're headed. And as Mike shared a lot of great content, particularly on the investment strategy, year-end is a great time to dig into your portfolio and review that holistically. You want to ensure that it aligns with your financial plan and also confirm that the risk you're taking on matches your tolerance and your long-term goals. And what we find is that many investors manage their finances in silos. You might have a 401k at your employer. Maybe you have another 401k from a prior employer, a checking or savings account, a high-yield savings account, and then even a mix of self-managed accounts and advisor-managed investment accounts. And maybe if you're married, your spouse has a retirement plan too. But oftentimes we see that each account has its own strategy. It's not part of a cohesive plan. And that's where we'd encourage you to have awareness on all your accounts and understand that asset allocation, the breakdown of stocks, bonds, cash, other diversifiers like real estate and commodities, and then even watching for concentrated positions. So we've seen with some of the tech positions, as Mike highlighted, those have performed exceptionally well, but are you too heavily invested in a single position? So evaluating that risk as you look at your entire household and then make a plan to diversify where needed is a great opportunity to review as we approach year end. Another thing is that ensure your cash is working for you. And while we've seen money markets be at all-time highs in recent years, to Mike's earlier comment, as the Fed cuts interest rates, we will see those yields start to come down. And ensuring that you set a threshold for how much cash you realistically need to maintain and invest the excess beyond that. But looking at all these different buckets that you may have, we use a financial planning tool to help aggregate accounts and assess household asset allocation. There's also tools like Quicken and Morningstar that can help you to track this information, especially if you're not doing this already. It's a great time to dig into that level of analysis. So as we talk about these different opportunities, another item we want to highlight when it comes to your investments is tax loss harvesting. So moving on, in taxable accounts, you have a joint account, maybe an individual account or a trust, and you'll have winners or losers. And the losses can serve a purpose when it comes to that tax strategy. And so in this scenario, if you have $25,000 of realized short-term capital gains, you also have $15,000 of unrealized losses. Without selling those losses, you'd owe over $9,000 in taxes at the highest tax rate, 37%. But if you realize that $15,000 in losses, you're able to reduce your tax bill by over $5,000. And we do hear a variety of objections when it comes to, do I want to do this? Do I really want to sell the stock? But we'd encourage you to reflect on selling the stock, capturing the loss, and you can wait 31 days and repurchase that position to avoid wash-sale rules, but still maintaining that holding for the longer term. So the goal here is a smart, small move that helps to keep more money in your hands at the end of the day. So another big topic as you think about this strategy and other planning opportunities is tax planning. So talking more about tax planning is a vital part of financial wellness, and helping clients proactively manage their tax situation to maximize opportunities, but also minimize surprises. And going back to the financial plan, do your financial goals align with your tax strategy? One example we explore with clients is the opportunity to spread capital gains or even IRA distributions across 2 calendar years. And that really helps to avoid a spike in taxable income and minimize overall tax liability that would be due in a single year. But for families planning a major purchase, for example, looking at their portfolio and having thoughtful timing and coordination, that can make a significant difference. And with this adequate planning, the goal is to achieve their main priority without significant tax consequences. And while there's several areas that we collaborate with clients and their tax professionals before year end, especially in light of the recent tax law changes, it's difficult to fully evaluate this without doing a deeper dive into the tax return. So with that, Carrie will walk through more about how we approach reviewing the tax return and think in more depth about tax planning.
Great, thanks, Molly. So, as you just said, tax planning is a central pillar of the holistic planning that we do with clients on an ongoing basis. And the first part of this deeper dive analysis is understanding what happened in the previous tax year, or maybe even previous several years. We like to call this looking in the rear view mirror because, of course, while there's not much that you can really do to change the past, it's important context to know where you're going in the future. So as you can see on this slide, this is a snapshot from the tax planning software that we use, and it highlights a number of different important metrics that we feel are important to have clients be familiar with. So, you can see this report captures a lot of information, but some key stats to touch on in this example are where your income and deductions ended up in the previous year, what your tax filing status was. Maybe it was single or married filing jointly, or maybe it's even filing separately. Understanding, and also I almost forgot to mention, marginal and average tax rates too are critical to understand, as well as identifying if there are any carry forward capital losses. And, we feel that it's really important to understand a client's most recent situation because it allows us to ask them better questions, specifically if they expect any significant changes going forward. Because we feel that making smart decisions, particularly at transition points in your life, is where tax planning can make the most profound impact. So let's look at the next slide. Because we call this process looking in the front windshield. We work with clients to project expectations of the future, of course, as best as we can, so that we can put together a strategy to capitalize on any planning opportunities that might exist. So in fact, we can game out potential ripple effects of certain planning strategies. For example, Roth conversions are a popular topic, and we can gain an understanding of what the actual dollar impact might be, and if it makes sense to for example, pay taxes now or continue to defer that tax liability into the future. So in this example, Mr. and Mrs. Sample are at a transition point in their lives. In this case, it's their retirement. And they're trying to figure out if there are any smart moves that they can make now because they're expecting a significant drop in their household income in the next 2 years. So as part of our planning process, we create several mock-ups of their tax calculation, which is shown in this slide. Scenario 1 shows what happened last year, of course, and scenario 2 shows what we would expect their situation to be in the first year of their retirement. So in the taxable income line, you can see that they're expecting their income to drop from about $517,000 in 2024 to about $104,000 in 2027. Then in scenario 4, they're also expecting their taxable income to then increase again to almost $290,000 when they start taking required minimum distributions in 2037. So these are kind of the known knowns. So scenario 3 is where the planning comes in. And it shows what might happen if they implemented a Roth conversion in 2027. So in other words, they want to know if it would save them tax dollars in the future if they convert $25,000 of pre-tax savings now into a Roth IRA so that it can grow tax-free thereafter. Now, there are several factors to weigh to decide if it's the right fit for them, but one step is comparing which bracket a $25,000 acceleration in income would push them to compared to their tax rate at RMD age. And by initiating a Roth conversion, they can essentially fill up that 10% tax bracket to its full potential while it's still available to them. Essentially, it's helping to avoid them leaving any low tax rates on the table. So being able to visually compare these decisions side by side, we feel is an invaluable opportunity for clients. So let's move to the next slide. Tax planning is just one piece of the plan. There are many milestone ages and decision points that start around age 55 that will have an impact on your tax profile and also on your financial plan. And these are all things that we help clients plan for and navigate through. And so as we just saw in our last example, many people have an opportunistic window between when the time that they stop working and when required minimum distributions kick in that can be great for tax planning. And additionally, people who are at least age 70 and a half and also have traditional IRAs have a unique opportunity to donate to charity while it's also helping to reduce their taxable income. And we'll touch on this a little bit more towards the end. But it's no surprise that there are a lot of decisions to make when it comes to Social Security. For example, do I claim early? Do I wait until full retirement age? Do I delay as long as possible? There are pros and cons to all of these choices, but forecasting your future income sources and thinking about your overall health can help you narrow in on what would be best for your situation. Health insurance decisions are also really important, especially as the cost of care and coverage continues to increase. And a common pattern that we see is people staying on their private health insurance through their employer while they're still working, and then timing their retirement date to still remain covered by COBRA until their Medicare coverage kicks in at age 65. And another strategy that can offer even more flexibility is if you have access to an HSA, you can let your tax advantaged contributions grow over time and then use them to pay for things in the future, like Medicare premiums in retirement, for example. And also, in fact, after age 65, HSA funds don't even have to be used strictly for qualified medical expenses anymore. So you can almost think of your HSA as another source of retirement savings in the future, which is pretty awesome. All right. So another important part of many people's plan is philanthropy, and we also love helping our clients fulfill their charitable goals in a tax-efficient way. And there are several ways that you can be strategic with your gifts. First of all, many charitable organizations accept direct donations of stock, particularly highly appreciated stock. So, for example, if you bought a share of Apple and that grew over 10 years, now it's worth much more and you have an unrealized capital gain. And if you were to sell that position, you would owe capital gains tax. So if you donate that share of stock directly to the organization of your choice, you can avoid the capital gains tax that you would have been subject to if you were to sell that position and then donate the cash. So this method of donating to charity can also help you claim a tax deduction if you itemize your deductions. However, what if you want to support many different organizations with your gift instead of just one? And that's where donor advised funds come in. These are also known as DAFs, and they are special charitable accounts that can allow you to still make that gift of highly appreciated stock and also claim that itemized tax deduction, just like if you were to donate that stock directly. But once the funds are in that account, you can control the timing and the actual amount of your donation to that are that are subsequently distributed from that account. So, for example, instead of potentially donating $10,000 worth of highly appreciated stock to one charity, you could use that same gift and fund a donor advised fund. And then thereafter, you can request distributions in the amount of your choosing to a variety of different charities. So it can really allow for lots more flexibility around the ultimate gift that goes to whatever charity you prefer and the timing around that. So that leads us to the concept of stacking. And this strategy is also most easily facilitated using a donor advised fund. And the idea is that you can stack several years worth of charitable donations into one single year. You can claim a larger than normal itemized deduction, ideally timed in a year where you would expect your taxable income to be high. Then this type of account will allow you to distribute those funds at your own pace. So if you have a goal of an annual goal of a certain amount of charitable donations, you can still distribute those funds at your own pace and achieve that annual giving objective while you can still claim that tax deduction in the year that makes the most sense for you. So it can allow you to be quite flexible in that way. And finally, it's also possible to use a pre-tax retirement account for charitable giving once you reach age 70 and a half, as I previously mentioned. And this is known as a qualified charitable distribution. And this strategy can help people limit the amount of taxable income that they incur from taking distributions from pre-tax accounts. And it can also count toward your required minimum distribution amount at age 73 or 75 or even beyond. So let's move on. This conversation, of course, just covered a slice of what we work with clients on all year long. And we hope that you come away with some ideas that you can start to work on before the end of the year. We encourage you to use this slide as a checklist for yourself to stay organized. We're also more than happy to dive deeper into any of these specific topics in a one-on-one conversation, because of course, every person's individual situation is unique. So I can move on to the next slide. Now, as we always say, a goal without a plan is just a wish. And as Barbara and Nancy said at the beginning, we really encourage you to make your financial well-being a priority before the end of the year.